Tuesday morning, and there he is, Mr. Pargamonic. How you doing, D?
Good morning, Will. How are you?
Let's jump right to the disclaimer.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's a disclaimer.
All righty. What's on plan for today?
So I think we'll talk about the Skew, and I'm going to use SPY as an example. Today, we'll kind of continue what we went over yesterday. I went kind of through a lot of pages yesterday. Maybe there's too many, so I might just slow it down and explain like kind of what does this Skew mean, because we think of Skew, implied volatility, Skew and options in terms of, of implied vols. But maybe what we'll do today is like actually show the options, kind of make more sense of it. What does this Skew mean? Put it into a relative perspective. Okay, so we'll talk about the Skew, the cost of these options, how to compare them. And maybe what I'll do is also just step away. Sometimes you step away and just show a different analogy before we go to the SPY, and maybe it will make more sense. Okay?
Now, I put the link over so people could join us on the Zoom. If you have a question, do you want them to raise their hands? Do you want them to ask it live?
Yeah, if you want to ask a question, there are a couple ways. Put it in the chat. If it's kind of like a quick, simple question, put it in the chat. If it's more involved and there are other surrounding circumstances or something that you've experienced you want to share with us, you could click on that link. We'll put it in there. That takes you over to Zoom. When you're in Zoom, you could raise your hand. That signals to Will that you want to come in and ask your question. You don't have to turn on your video, but turn on your audio so we could hear it. That'll be the benefit to everybody, to the entire community, and we'll also be able to you'll guide us so we could see what the setup is and what the circumstances are. So again, two ways to ask it. One is just put it in the chat. The other, you could come over to Zoom and just ask, turn on your mic and ask the question. Sound good?
Yeah.
All right. So before we get started, I'll just quickly take a look at what's going on in the pre-market hours. Then we're going to move on and talk about implied volatility Skew. Okay. So this here, these are stocks that are moving in the pre-market hours or trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Today we got 203 stocks made our percentage gainers list, 28 on the percentage decliners list. So from that perspective, looks like a bullish bias at the open. I'm going to take a look at the higher market cap stocks, see if we see a similar situation. So market cap 20 billion or higher, using this filter here, 62 made the percentage gainers list, 1 on the percentage decliners list. So from that perspective, looks like even in the higher market cap stocks, much more bias towards the bullish side at the open. So if no questions on the pre-market, Will, I'm just going to start kind of looking at the Skew, maybe just showing an analogy that I try to set up, and then we'll take a look at the numbers. We'll take a look at the benchmarks and what the Skew is showing us. Sound good?
Excellent.
All right. So what we'll do is we're going to go to the SPY. Sorry, SPY, and right now I'm on the SPY overview page, and we kind of went to here, the risk premiums, and we started looking at these different benchmarks down here. So these different benchmarks are measuring 30-day maturity, 1 month, 60-day maturity, 2 months out, 3 months out, 120-day maturity. So what it's doing is it's benchmarking through a formula. It's because we don't always have 1 month out, 2 months out. So what it's doing, just like the VIX, we're using benchmarks first on the maturity, and then we're looking at the options based on a weighted average, the cost of these options based on how far away they are from at the money, right? So we got the at the money options, then we got the out of the money options here. So I'm going to come back to this to explain the skew, but before we talk about the options, I wanted to kind of maybe go look at what I mean by skew. Okay, so I kind of just created this little wagering. We're in football right now, football seasons, a lot of people bet on teams. So I wanted to kind of describe like what the skew means if you're betting on, like football teams. So one way that you could bet is on the team A or team B winning, right? And that's, there's going to be a winner or loser. Let's say, there has to be a winner or loser. So you either bet on team A or team B. And that's one way of wager, probably the most common. But you could also do something different. And let's just say team A and team B have equal odds of winning. So they're both same caliber. There's, one team is not better than the other team. So they equal chance of winning. Okay, team A or team B. But let's say you do a different type of bet, and here's how I'm setting it up. It's kind of like when we talk about skew, because we're talking about, looking at wings. So let's say that the wager is whatever, you have to pick the winning team, but the team that wins has to score above 21 points. And for every point that they score above 21, you get $1, right? So the game could be played and neither team scores 21 points, then you don't win, right? So the winning team has to score above 21, and whatever. So let's say this winning team scores 30 points and you bet on that team, then you get $1 for every point above 21, you get $9. Okay. So the higher they go, the more you win. If they score 22, you get $1. And that's kind of like when we talk about the wings, right? Not only does you have to be right, but it has to be by the magnitude. And let's say right now that what is a skew? So let's just say team A, the wager will cost you $1, right? So team A, you bet $1. If they win by more than 21 points, you get $1 for each point they score above 21. But let's say team B, so this is team A, right? So that's the cost of the wager. Team B, the wager is 10 cents. Right? So in other words, maybe you believe that it could be team A or team B, either one could win, right? And either one's equal odds of winning. Maybe in your mind, it's equal odds of them scoring above 21. So there is a skew because you get the cost to bet on team B is much less, right? So I could do, for the same price, I could do 10 times as many wager. If I bet $1, that means I bet 10 times as many as team A. And that's kind of like, I'm trying to describe like what a skew is. Okay. That's where this team is skewed much lower relative to the amount that you bet. And now we're going to take a look at the SPY, like how that sets up in SPY. And I'm going to use SPY. I'm going to come out of here if there are no questions on this setup.
Yep, you can move forward.
Okay. And why I use SPY is that the market, nobody really knows, right? SPY, it's the S&P 500. So the idea is that nobody really knows if the market's going to go up or down because there's too much information, too many different players involved, a lot going on there, So the idea is it's equal chance going up or down, right? Right at any moment. And I'm going to look at it 2 months out. Let's look at it 2 months out expiration, 60 days to maturity. So in the next 2 months, we have no idea, we don't have a reason right now to believe that it'll be up or down from this point. Any kind of news could come out, good news, bad news that could send it in either direction. And when we look at the wings, let's also pretend that we think there's that in our mind, there's an equal chance that it could go up 5% or down 5%. We don't have any reason to believe that it should go, go in either direction, and the magnitude of the moves could be equal. So how do those bets line up? And I'm using SPY because I think in a stock it could be a little bit different. So I'm using in a stock, stocks have their own nuances sometimes. It could be a biotech stock. It could be, so I'm using SPY because there could be a very good reason for skew in an individual stock. Like just really quickly, let's say a biotech stock, they have clinical trials or studies, and if it goes bad, then the stock is like worthless, it's going to zero. If it goes good, then they could collect more money and continue. So there could be reasons for stocks to have skews, and you'd have to analyze it. But in SPY, let's just say that there's an equal chance of it going up or down by any magnitude. So let's take a look at a 60-day maturity. And here's a put premium, and I'm going to go 5% out of the money. So this is a put that's 5% below the spot price right now. And that put premium right now is telling us that it will cost us a 1.79% percentage in premium. Okay, put premium. So if the stock, imagine if the stock is at 100, it costs us $1.79. Okay, in that's what this put would cost us to protect us 5% below. Right, that's when it kicks in if the stock falls 5% or more. And the call is 0.63. In other words, that the call would cost us 5% above 63 cents. Okay, so you guys seen the difference in the price, right? So one is skewed higher than the other. So if we thought it was equal chance, then then the call looks like a better deal, right? If there's an equal chance over time that it could go up as much as it could go down, then now the call seems like a good deal. But we could also compare that to the historical averages. Are we getting a good deal based on historical skew? And that we could look at the historical benchmark. So here, a 5% out of the money put usually on average is 1.57%. So we see we're above there, 1.79. And on average, the call premium is 0.75%. So we're below that. So above the average in the put, below the average in the call, meaning that skew right now is lined up more towards the put side, right? More demand on the put side than the call side on a relative basis. So this is kind of what the skew is. And I'm going to go to the options chain and kind of show you what that looks like, okay? Now, when you read about a lot of times in the skew, and you're going to read headlines like, the puts relative to the calls are very expensive, and they'll compare it. When they look at it, a lot of times they'll go to the 10%. Now, I think 10% just is a very extreme in the SPY, but we'll take a look at the 10% because that's where you probably read the headlines. So let's see what the headlines kind of say. And here's what the headlines will look like usually is that, well, if I'm paying, 1% for an out of the money put, and I'm barely paying anything for the out of the money call, 0.5%, that's like I could get 20 calls for one put. Okay, so let's take a look now at the options chain and look at the numbers and see kind of the actual costs. So if no questions here, well, I'm going to move on to the options chain.
Yeah, you can move on, D.
Okay. So remember, this is what we're going to look at. 2 months out, 10%, 10%. Okay, now when we look at it, remember, these are benchmarks. So this isn't going to be exact because you don't always have exact 60 days to maturity, and you don't always have exact 10% and 10%. These are benchmarks. So when we go to the options chain, we're going to get as close as we can to 60 days maturity, and as close as we can to 10% and 10%, right? So it's not exact, but these benchmarks are giving us approximations. So what we should see is that this put is approximately going to be, this much higher than this call, right? Because we're not getting, these are not exacts, right? So let's take a look at the options chain here. Going to the options chain, and right now we're on September 21st today. So I'm going to go to the options chain. Let's say, it's October is 1 month, so we need somewhere like this, November. Okay, so November 21st, 2 months out. And I don't know if there's could it be even holidays, but let's take a look at 2 months out, and I'm going to find the 10% out of the money call and 10% out of the money put. And we're going to treat it as there's an equal chance that this thing could skyrocket on good news or plummet on bad news. Okay, that's what we're looking at right now. And I'm going to find the strike that's 10% out of the money. So look, I'm going up, up, up in strike as I'm hovering over it, right? As I'm hovering over, it's telling me the percentage away from the spot price. So I'm right around there. I don't have an exact 10%, but let's just say 478 is the closest. Okay. So 478, I'm coming over here to the call, and that'll cost me 27 cents. Okay. So 27 cents to buy a call option that's 10% out of the money. So obviously it needs to increase by more than that. If I just buy that and hold on to that, it needs to increase by more than 10% for those options to start being profitable. Now I'm going to go the other way and compare it 10% out of the money. Okay, so now I'm going down in strikes. So we closed around 430, 433. Let's go 10% out of the money. So here's 10%, approximately 391. So that put 391 is 491, right? So I'm just gonna to put them side by side. So we see here, here's the cost of 10% out of money call. Here's the cost of 10% out of the money call. So what does that mean? Look at the costs here. If I thought there was an equal chance, let's say that it could go down, up 10, 12%, down 12%, or up 15%, down 15%, right? An equal chance of it doing, maybe the odds aren't exactly 50-50 that'll do that, but if it does it, there's an equal chance. Maybe 10% chance it goes up that much, 10% chance it goes down that much. But I don't have any reason to believe one way or the other that there should be a skew. What this is telling me, what I'm looking at, is that I could buy for the price of one put. What it cost me to buy one put, I could buy, what is that, 18 calls, right? So 18 calls. Let me do the math here real quick. Let me see if I'm right. Something like that, right? We're talking about approximately, I think it was like 20. So 4 so about 18 calls for the price of one put. That's what the skew is telling, right? That's what the skew is letting us know, that's how much skewed lower the calls are versus the puts. So do people see that real quick? Right? So is that even possible, right? Can the market go up, or down 10% can do that, in a 2-month period. So we could go look in history and see how often that happens, right? And I'm going to use a tool to see, well, how often did in a 2-month period the market go up more than 10%? How often did it go down more than 10%? And what are the magnitude of the moves? Okay. So if everybody is okay with this, I'm going to move on.
Yeah, we did have one question pop up from Albert, who's a regular. He's asking, how do we use Skew to structure diagonal and or calendar spreads?
Okay, so I'm going to get into diagonals and calendar spreads, and I'm developing it because calendar spreads and diagonal spreads is something that I've been getting a lot of requests to add screeners to, and I'm working on it. There's more things involved with diagonal and calendar spreads because we're not talking about a vertical skew within the same month, but we're also talking about a horizontal time. There's a skew between expiration dates. Okay, so there are certain periods where you want to be long the calendar, like long the outer months, and short the shorter dated, and then there's certain periods that you want to be in reverse. Okay, and we'll talk about that more, but I think for now let's just stick within the same expiration month.
So he did pop in another question. Might as well get it on the books, so when you're going through this next process, you're thinking about it. If he's asking, what's the basic logic? Sell Skew premium and buy less expensive premium longer term options to hedge or even potentially profit from Vega convexity? These are all questions.
And that's what you have to determine where you think that, right? And remember, some of it will have to do with your assessment of all the data surrounding, right? So when it's where you feel comfortable with your assessment of all the other data, and you think that, well, I think that there's an equal chance it could pop higher or lower, and this gives me a good amount of edge. So as long as you kind of know how to read the data, I think that there's always this, instead of kind of learning and analyzing the data, I think there's too quick of eagerness to jump to what should I do in this situation, and it's not like that right now. I think what's important to is understand it. Okay, understand it, and when you understand it, it's going to fit into your entire strategy over time. Okay, think about it as, if you're playing chess, right? And if you're playing chess, I cannot tell you exactly what to do because there's always new information coming in, because not only do you have to examine all the pieces on the board, but every time there's a move, there's new information and something is changing. So there's no exactly what you should be doing. It's more like, if you understand the data and information in front of you, you're going to be able to incorporate that into your overall trading, and you're going to benefit from it because you're going to start seeing situations where it lines up favorably to you. Okay, so think of it as, the more times you play chess, the more times you've seen certain situations, and that it's better for me to make this move than that move, and you need to see all the pieces, all the other pieces, how they're lined up, the better you get at it. Okay, but there's no one rule or two rules exactly what you should be doing. It's all based on all the other surrounding circumstances that are happening around you, including maybe what you have, your positions as well, right? Because your positions play a big part in what you can and cannot do.
And it may also be beneficial relative to your particular brokerage account, right? It may, like Jake just said, it's a classic risk reversal, and you're using the downside puts to finance the calls. So
exactly, like maybe you have, let's say you have a lot of short positions on.
AD, you just went underwater, sounding a little fishy. Uh,
really?
yeah,
Okay.
you want to either try shifting your mic or maybe log out and come back in.
I don't know. Does this sound? Let me. I'm putting the mic as close as I can. Does it sound better?
No, it's about the same. It's all garbled.
I got it. Let me try that. I mean, we have 5 minutes left. Do you want me to continue this?
Yeah, just go out and click back in on the link. I'll just let everyone know about our webinar tonight with Raj.
Okay.
For those who don't know, I did put the link last from yesterday's webinar at 10 with Jake. He went through his processes when looking at volatility and market volatility, and that is, like all our videos and webinars, immediately available on the YouTube channel. So I put that link in the chat, and we have Raj coming on tonight, another one of the Discord family. If anyone is new, I know we have a New Zealander on today, which is great. And I'm going to instead of GM in the morning, now I'm going to say, type in G'day, which I love. So I'm going to put the link to Raj's webinar in the chat. If you can join us today at 6. And Goat's in the house. Good to see Goat. Goat, we missed you in Jake's webinar yesterday. You always bring good comments. Thanks for joining this morning. Let me get the link for Raj's webinar in there tonight. And that is at 6 Eastern time.
Right.
All right,
Okay.
D.
So how does that sound?
Perfect.
All right. So where I left off was, okay, there's a 10%, right? We're looking at 10% out of the money put, 10% out of the money call. And maybe we want to just see the history of the stock even doing that over a 2-month period. So I'm going to just leave this part, and we're going to go to the price action analysis tool. And that's one thing that I think Jake showed us yesterday. So let's go to SPY, and I'm gonna do intervals of, in the last 4 years, what is 2 months trading days, like 45 days, something like that? Well,
Yep.
let's see if I could put that in there. So we see in the last 4 years, right, over a 45-day period. These are the statistics, but really quickly, I don't have a lot of time. So I'm going to put in 10% move. So here's a 10% move. So it happened 1 time to the downside, 3 times to the upside, right? So on a percentage basis, it actually did it more times to the upside to the downside. And we could see here, well, what about the magnitude of the moves? So top 10. So we could see here to the downside, the magnitude of the move was greater, 16.3. Magnitude to the upside, not as great. These are just historical references, just to see how this moved historically, but it happened more often to the upside than to the downside, but not as great of a magnitude, right? So 11.1%, 11.1, 11. So you could see here, right? Almost as far as the magnitude of the move, it happened. As far as the frequency, it happened more times to the upside than downside, but the magnitude to the downside was greater. But this kind of gives you an idea of, historically these really big wins, right? So I did a 10%. Obviously, you could do 5% or so forth, but that's kind of like where I'm trying to show like the skew in the options and on a relative basis how they're lining up. And a mean reversion, what we could see is not only there are 2 ways to play right. One is just an outright, buying one or buying the other, selling one, selling the other. Or mean reversion will be, if things come back to normal, will the puts line up closer to the calls based on the historical averages, right? So that would be the mean reversion. Will those puts either come down closer that they're more in line with the historical mean, or the calls will go up closer to where they're lined up more with the historical mean of the puts? So again, really quickly, try to get a little bit deeper in the skew, show you how that looks, and it's more important, I think, to understand things and understand how things are working, and over time experience it.
Hey,
You know,
D, just Robert is saying you just need to share your screen.
oh, I didn't share my screen. Sorry.
Yeah, no worries.
Okay. Yeah. Well, yeah, you should have.
Yeah, it's a delay. I didn't notice it. I'm sorry about that.
Okay, so here's the screen. I went to SPY, historical distribution. I set up 45 days because that's about 2 months of business trading in the last 4 years. And then I just put 10% in here really quickly. So I see here 10%, the amount of times it fell below 10%, that was one time. 3 times it was above 10%. And then I went here just to take a look at those extreme moves, top 10 moves above 10%, happened 3 times. All right. Amount of times it fell below 10% happened once. So you could see here 16% when it fell down that one time. The 3 times that went up was about 11%. So it didn't go too much higher than the 10%, but it was more frequent. So that's really quickly, what I was doing is looking at the price return distribution from a historical perspective. So real quickly, hopefully that is helpful. Yesterday I went through a lot. I think we still did a lot today, but not as much as yesterday. Looked at less things.
That was super helpful, D. Great job. Thank you so much, my friend.
Okay. Well, everyone, thanks for joining. Stay safe out there. Have a good trading day. We hope to see you guys are doing a webinar tonight. Well,
yeah, with Raj. Always
okay.
Exciting. Big
Awesome.
week of webinars. And then we have you tomorrow on the Traders Exclusive Expo, I think, and I'll send out a link for that. And then when Thursday, we have Donald Williams coming on, who's another trader who's using the Chameleon for different things. So a lot of stuff going on this week for the Chameleon community. Awesome job, D. Thanks so much.
All right. Thanks, everyone. Stay safe. Have a good trading day. Hope to see you.